I guess the way to start off our conversation about the markets and where you see opportunities is to get your sense of where we are in the cycle, whether it's the credit cycle or the economic cycle or the business cycle.
Sure, so just to start with the overall economic cycle, since 1850, this is the second largest expansion of 9 years. We're 1 year away from being the largest expansion. So that sets up, so it's been quite a run. Now that's on length of expansion. In terms of the duration of expansion, that's different. Excuse me, the magnitude of expansion, that's not been as impressive. So it's been a pretty long expansion. In terms of how long it can be, I don't have a crystal ball, but if you look at other countries where there has been a good, a long growth like Australia, where there's in their 26th year, the last 10 has had 4 drawdowns. So why I'm citing this is I think the market's going to be skittish as we get deeper into the cycle, regardless of whether we actually have that slowdown or not. And so I feel we're going to get chances. Looking at in terms of, so now going to the credit markets and the valuations. The rate or spreads are at 10-year tights, about 330 off. If you look at the dispersion in the market, also not very attractive. Most of the market's trading above 95%. In fact, usually it's about half the market in as you get stressed environments to 60 to 70% will trade below 95. So we feel, simply put, you're deep into a cycle, and the market historically has doubted how long cycles can be as you get further into it, and yet we're being priced as if we're in the mid-cycle and that we have a lot of years. Okay,
so it's more glass half empty, but the pricing creates a little bit of a dislocation, perhaps an opportunity. We also have rising rates.
Yes.
And higher rates from where you stand as a credit investor means more choices.
Exactly.
So what kind of choices are you looking at?
So we think that higher rates will result in more choices, but if you look at dispersion and if you look at spreads, it's still pretty tight. Now that's the headline numbers. If you look in terms of volatility, it's behaved differently.
Okay.
So like for instance, if you look at some of the problem situations, like take last year, Toys R Us. Toys R Us announces they have liquidity issues. The debt goes down 5 points. On some of the senior notes goes down 5 points, call it 90 to 85. Within 4 or 5 weeks, the debt goes down to the 20s. Contrast that with last week, American Tire, a $500 million EBITDA company, announces that that 2 of their large suppliers, Bridgestone and Goodyear, are forming a partnership to compete against them. And those bonds go down within 48 hours, 48 points. So in one market last year with Toys R Us, it was innocent until proven guilty.
Right.
This market, last week with American Tire, it's guilty until proven innocent.
All right, so there's new level of skepticism, and people are definitely making distinctions here. Let's talk a little bit about the entry points in credit, because I know you believe there will be better entry points.
Absolutely.
Certainly in the European high yield credit, perhaps in the US as well. You're looking abroad.
Yes.
And you're finding value in Latin America.
Absolutely.
Talk about Argentina.
Sure, so in Argentina, what's fun about Argentina is there's so many different ways to play it. And you can see the local dollar hedged. So the easiest way to play it, if you're able to do this, is to buy the local debt and then just hedge it into US dollars. So call it debt that's less than a year. You can get call it 9%, and then you can have short US dollars against it, or US dollar debt, and that's 5%. We actually happen to like Argentina, so we're not hedging, but you can get that discrepancy, and usually we call it interest rate disparity, because usually it converges, but because there are a lot of different options and there's not enough players in the market to arbitrage it out. It used to be actually a lot of the trading desks, Wall Street trading desks, were one of the primary players to arbitrage those differences out, given their cost of funding, but they're out of that market. But in Argentina, you look at the provinces, the local debt provinces versus the sovereign, and we think they're all very similar risk, trading all over the place, and we think it's exciting and excellent value.
And in fact, you called it as wide a credit arbitrage as you've ever seen in your career.
Yes, for the quality of asset it is and how deep it is. So sure, we've seen wider arbitrages, but it hasn't been this liquid.
Got it, got it. Let's talk about some companies in particular. Altice, for instance, $40 billion in debt. You're looking at that. What's your thinking here?
So Altice is basically two businesses, or two primary entities. One is North American, Altice US, and then there's the international. The international, which is the parent company spinning out the US, and so the international stub we find very interesting. It's pretty much a closed-end fund of a lot of different cable assets. And we think it's, people are aggregating everything and not valuing the sum of the parts correctly. So we think that's an interesting opportunity. And with all the debt, there are ways to capture some of the discount. It trades for about a half a multiple of EBITDA, and we think that it's a very levered play on many things that can go right.
Now, of course, you're looking at the credit side, but for those who are looking at the equity side, you made an observation to me, and it's something that we've heard from others as well, which is equity investors seem to be a little bit more pessimistic, skeptical, bearish even, than credit investors. Why is there this discrepancy? What do equity investors see that credit investors don't, or vice versa?
Well, that's a great point to raise, because most cycles, not every cycle I've been involved in, you've had the debt markets lead the equity markets with not willing to fund certain industries or making it much more expensive. Here in this cycle, the industries in transition, whether it's retail, retail, telco, telecommunications, media, and energy, the equity markets are much more punitive and critical than the debt markets, which is focusing on the ability to pay the bills and potentially refinance in the next coming couple of years or so. Whereas the equity market is looking at their long-term trends and what the residual values are, and is taking a much more critical view. If you look at one of the trades that's worked the best in the equity markets, it's being long thing and short what thing is displacing, and it's largely the industries I just mentioned, with the exception of energy.